students, now we go to the next topics, companies and financial statements. What is the definition of companies? Companies is an organization that operates with the goal of making a profit by selling products to customers. There are three types of companies. The first is service companies, second merchandise companies, and the third is manufacturer companies. Here is the example of service company. Service company is producing services for customers. Services are tasks or activities performed for a customer or activities carried out by a customer using the company's products or facilities. There are some characteristics of service company. The first is intangibility. In intangibility, the buyer cannot see or taste of a service before the service is purchased. Inseparability. The company and buyer of the service must make contact at the time of exchange. The third is heterogeneity, the opportunities for greater variation in service company. And the last is about perishability. The service cannot be saved for the future. There are a lot of types of service companies activities: communication, rental, training or skills, professional service, finance and funding. And the second types of companies is merchandise companies. Merchandise companies buying and reselling goods without significant further processing. And here are the operational characteristics of merchandise companies. There are a lot of activities of trading, including purchase, marketing, diversification, storage, sorting, quality control, delivering, and risk control. The next company is manufacturer company. Manufacturer company converting raw materials into finished products through production or manufacturing process. There are three types of companies based on ownership. The first is proprietorship, the second is partnership, and the last is corporation. Proprietary companies. The advantages of these companies is easy to manage and low cost, but the disadvantages is limited resources and unlimited liability. Partnership companies has advantages. The source of capital is better than proprietary businesses and need more management skill, but the advantages is unlimited liabilities. The last is corporation companies. Corporation companies is the company was formed that based on government regulation as a separate legal entity. The advantage of this company is great ability to attract capital by issuing shares. But the disadvantage is the government imposes taxes on its various activities. And here is the influence of accounting. Accounting is a system that identifies, records, and communicates the information that has characteristic relevant, reliable, and comparable. The information should has all of its characteristics supposed to help users to make better decisions. We can see here the information process starting with its identification of stakeholder, whether the stakeholders is internal or external. And the next is analyzing the type of information needed by the stakeholder. The third step is designing accounting information systems to meet stakeholders' information needs. Based on accounting information system, we can record the transaction and activities. By accounting information system, we prepare the financial statement for stakeholder. The next subtopic is about financial statements. After transactions have been recorded and summarized, reports are prepared for users or stakeholders. The accounting reports providing this information are called financial statements. The primary financial statements of a corporation are income statement, statement of changes in equity, statement of financial position or balance sheet, statement of cash flows, and notes to financial statements. Income statement. The income statement reports the revenues and expenses for a period of time based on the revenue and expense recognition principles. These principles match revenues and their related expenses so that they are reported in the same period. The excess of the revenue over the expenses is called net income, net profit, or earnings. If expenses exceed revenue, the excess is a net loss. Statement of changes in equity. This statement reports the changes in equity for a period of time. It is prepared after the income statement because the net income or net loss for the period must be reported in this statement. Similarly, it is prepared before the financial position statement, since the amount of equity at the end of the period must be reported on the financial position statement. Statement of financial position. Statement of financial position reports the amount of assets, liabilities, and stakeholders' equity as of a specific date. Statement of cash flows consists of the following three sections. The first, operating activities, investing activities, and financing activities. Statement of cash flows from operating activities reports a summary of cash receipts and cash payments from operations. Statements of cash flows from investing activities reports the cash transaction for the acquisition and sale of relatively permanent assets. Statement of cash flows from financing activities reports the cash transaction related to cash investments by stockholders, borrowings, and dividends. Okay, students, that's all about today's topic about companies and financial statements. Our next topic is about accounting equation.